Think buying a home in California is still the ultimate dream? In 2025, that dream's collapsing under its own weight. Home prices are sky high, insurance costs are exploding, and affordability has hit a 40-year low. The statewide median home price now hovers around $763,000, while the median household income sits near $84,000, a ratio that makes California the least affordable housing market in the U.S. Mortgage rates hovering between 6.8% and 7.3% have pushed monthly payments for the average home above $4,200, and that's before taxes, insurance, or HOA fees. Meanwhile, nearly 1 in 4 listings across the state saw price reductions in early 2025, and major insurers like State Farm and Allstate have halted new homeowner policies because of wildfire and flood risks. Even cities once seen as safe bets, San Diego, Santa Barbara, and Burbank, are flashing red. So before you drop your life savings on a California address, listen up. These are the top 10 worst cities to buy a home in California in 2025, where inflated prices, rising risks, and economic stagnation could turn your investment into a financial trap. 10. Riverside, California. If you're considering Riverside, know this. The median home value in the region recently sits around $639,779. Yet it's down 3% year over year, signaling softening demand and potential value erosion. Meanwhile, homes are staying on the market longer. In one report, average days on market increased from 31 to 50 in a year. Now pair that with the fact that Riverside County is adding thousands of new apartment units, over 6,000 in one recent year, which spells more rental competition, lesser urgency for buyers, and added upside risk. On top of that, while it's been promoted as a relatively affordable alternative to coastal California, that very fact invites more speculative demand, pushing values up ahead of income growth and setting up for correction. Predictions suggest only modest price appreciation, 3%, in 2025, not runaway gains. For a buyer, that's a red flag. You're paying near $600K plus for a home in a market that isn't booming, could stagnate, and is facing rising supply. Sure, less risk of being wildly overpriced compared to coastal luxury markets, but the value proposition is weak when considering how much is being paid versus what you're getting. If your plan was buy now and hold for massive upside, Riverside might instead give you flat returns and rising carrying costs. 9. Fresno, California. Fresno might seem like a bargain compared to LA or the Bay Area. Median home value around $386,173 in early 2025. But cheap doesn't mean safe. The market has seen year 7.2% year-over-year price growth in early 2025, which sounds good, but that level of appreciation in a region with slower economic growth and weaker demand creates risk of overshoot. Also note that inventory and months supply are tightening, just 2.3 months in some analyses, which means competition remains strong, not always a benefit unless your financing and long-term holding plan are rock solid. Furthermore, the underlying local economy is weaker. Incomes are lower, job diversification limited, and migration flows uncertain. When mortgage rates remain elevated near 6 to 7%, as is the case in California broadly, the affordability gap hits harder in Fresno because less buffer exists. Add into that the fact that the local market is still a bit tilted towards sellers, and you're buying in a place with higher relative risk if the broader market chills. In short, yes, it's cheaper, but you're not buying much margin for error. If the macro slows or rates stay high, Fresno could be stuck with stagnant appreciation for years, meaning opportunity cost is real. 8. Santa Cruz, California. Now let's talk Santa Cruz, that idyllic seaside town, surfer vibes, redwoods, the works. Until you peel back the curtain, median home price recently has surged past $1.2+ million, while median household income lingers around the 85K range, an absurd disparity. Precise local income figure may vary, but the mismatch is clear. Note, general coastal income versus cost gap pattern from sources such as crash risk listings. Climate and insurance risks here are especially heavy. Coastal erosion, sea level rise, redwood, wildfire adjacency, meaning not only is the purchase cost high, ongoing risk and insurance premiums are also rising. Data from analyst lists show Santa Cruz among the highest overextended markets. Homes valued 50% or more above long-term averages in some cases. Inventory is also shifting. In Q1 2025, more than 25% of listings in similar coastal towns saw price cuts, and average days on market have doubled since 2023 in some zones. Those are not typical luxury market gluts. They're signs of marketplace stress. So buying in Santa Cruz means locking in extremely high cost today for future risk that is disproportionately climate-driven and market-driven. If you were imagining, buy for lifestyle, hold for golden years, realize you're also buying exposure to sea-level uncertainty, limited workforce retention, locals priced out, and a market that's showing early correction signals. 7. Santa Barbara, California. Turning now to Santa Barbara, stunning locale, Mediterranean architecture, beach town appeal. But again, homes are nearing $1.5 million, while average incomes sit around $90K. That creates a massive affordability chasm. The market is showing clear signs of cooling. Listing times up near 60% year over year, and nearly 30% of properties saw price reductions in Q1 2025 in similar markets. While I don't have Santa Barbara specific numbers for each, it tracks the pattern for luxury most coastal CA markets. The climate risk factors amplify the issue. Fire risk from nearby foothills, mudslides during winter storms, drought utility burdens, all increasing maintenance, insurance, and long-term cost of ownership. Many hillside homes now pay over $5,000 per year just for insurance, and some are outright denied standard coverage. Meanwhile, key service workers and local families are being priced out, contributing to workforce shortages, which constrains local economy and indirectly depresses long-run value base of housing. So, if you're considering buying here, you're not just buying a home, you're buying the risk of paying top dollar. In an environment where affordability is non-existent, downside risk is meaningful, and upside patience is required. In other words, lifestyle may be fabulous, but investment logic is questionable. 6. Palm Springs, California. Finally, in this set, Palm Springs Desert Oasis, resort-style living. But for buyers in 2025, the siren song comes with serious caveats. The median home price is around $675,000, with household incomes struggling to rise past $70K in the region. Again, big gap. Some sources list similar figures. The bigger issues, extreme heat. Palm Springs recorded over 60 days 190 last year. That drives up utility bills, infrastructure wear, cooling needs, and ultimately homeowner cost. Drought restrictions are intensifying, water bills rising, and wildfire risk in the Coachella Valley is non-trivial. Insurance premiums have soared nearly 50% in some neighborhoods in just 3 years, with many homes now classified high risk. At the same time, new construction and investor build-outs have created oversupply concerns. In Q1 2025, 31% of listings saw price cuts, average days on market exceeding 50. That's not speculative luxury. That's core home inventory. So you're buying in a place where environment is becoming costlier, returns are under pressure, and demand is uncertain. If you were drawn to the resort lifestyle, sure. But if you thought buying now is a dependable investment path, the odds of a meaningful correction or stagnant performance are higher than many realize. 5. Bakersfield, California. Let's start with Bakersfield. On the surface, you might say, hey, it's cheaper here than coastal California. And yes, the median home price of around $393,000 to $422,900 demonstrates that cheaper sticker than some other places. But don't let that lull you into complacency, because there are several structural issues that make this market particularly weak for home buyers in 2025. First, inventory and buyer demand are cooling. According to Redfin, in September 2025, the median home price in Bakersfield was actually down about 0.12% year over year, and average days on market climbed to 40 compared to 32 the year before. That indicates the heat of the seller's market is softening. More telling, a report noted that 26.7% of homes had price drops in January 2025. Translation: many sellers are having to reduce price to find a buyer. On the upside, it's more affordable relative to big metros. On the downside, the risk of stagnant or weak appreciation is high because economic growth in this region is relatively modest. Employment and wage growth lag coastal hubs, and over-optimism around value play may leave you with a house that doesn't keep up. If you buy assuming strong appreciation, you may instead face flat returns or even slight declines, especially if mortgage rates stay elevated and cost burdens rise. In short, Bakersfield may look like a bargain, but the bargain might come with a longer payoff period and more risk than advertised. 4. Vallejo, California, moving up the list to Vallejo. This Bay Area fringe city ticks many of the danger boxes for buyers. The median home value is reported around $518,178, having dropped roughly 4.7% over the past year. That itself flags weakness. A home purchase isn't getting cheaper, but the value is slipping. Even more, listings show the median listing price in August 2025 was $525K and trending down about 4% year over year. Add to that, the days on market were up 43 days versus 35 last year in August. These are signs of a market losing momentum. But the less obvious risk? The household income in many parts of the Bay Area fringe hasn't kept up with housing cost escalation. And the commuter premium effect, people buying here because they hope to commute to SF or the East Bay, is under pressure from hybrid, remote work trends. Also, renters are showing high cost burden levels. In Vallejo, reports showed about 2/3 of renter households are paying 30% or more of their income in housing, which is unsustainable. What that means for buyer: a weaker demand base, less local wage growth, and less upside for resale. If you buy assuming that the Bay Area discount will eventually translate into big appreciation, you risk getting stuck in a home without local fundamentals to support big gains. Vallejo might seem just affordable enough, but its downward trending value and income mismatch make it risky. 3. Stockton, California. And now, number 3, Stockton. This one carries serious caution flags. Historically volatile, Stockton is still grappling with structural issues. Although I don't have exact current median price in this summary list here, sources identify it among the most challenged for buyers. For instance, a past analysis flagged 5 California cities worst to buy, and included Stockton for significant risk. What makes Stockton especially precarious? 1. affordability strain. While median home prices may appear relatively lower compared to coastal peers, incomes in the region lag far behind, making the price-to-income ratio unfavorable. 2. Economic vulnerability. Sectors like logistics, agriculture, warehousing dominate, and these tend to pay less than tech-cost finance hubs, meaning slower wage growth. 3. Inventory and demand signals. Earlier data, though a bit dated, shows that Stockton had among highest foreclosure struggling market rates post-2008 and remained more cyclical. 4. Outmigration risk. Some residents are leaving due to crime, job uncertainty, or lack of services, which means the pool of stable long-term buyers shrinks. What does that tell you as a buyer? You're entering a market where upside is limited, structural headwinds exist, and if interest rates stay high or the economy softens, you could see values stagnate or decline. In essence, Stockton might look like a chance to get in at lower cost, but you're taking on meaningful risk in terms of future resilience. Unless your holding horizon is very long and you're comfortable with volatility, it's a market to approach cautiously. 2. Vallejo, California. Look, when you evaluate Vallejo in terms of investment or home ownership, you've got to weigh the lure of Bay Area fringe pricing against some deep structural headwinds. The median home value is hovering around $518,780, and more importantly, it has actually declined by roughly 4.7% year over year in recent figures. That drop is a flashing indicator. This isn't just slow growth, it's actual retreat in value, not what you want if your time frame is short to medium term. Further, listing prices in Vallejo in August 2025 averaged around $525K, and were down about 4% from the prior year. Homes are sitting longer too, days on market around 43 versus about 35 last year. Now consider the less visible problems. Vallejo's identity has been partly as a commuter suburb for the broader Bay Area. But with remote work baked in and rising costs, that commuter premium is eroding. Local incomes haven't caught up, and the renter base is stretching thin, many renters spending more than 30% of income on housing in the region. The economy here is less diversified, and the margin for error is small. What does this mean for you as a buyer? If you purchase assuming that Bay Area expansion will rescue your upside, you may find your holding costs high, your local demand weak, and resale harder than expected. In short, Vallejo may feel like a deal, but the fundamentals suggest a weaker future return risk. 1. Stockton, California. And now, the toughest watch-out of all. Stockton carries major structural baggage that makes it the #1 city on this list for risk in 2025. While it may appear affordable relative to the coastal markets, the median home value, though lower than state averages, is still disconnected from the income base and the broader market dynamics. According to a February 2025 report by Norada Real Estate, the median sale price was approximately $420,000, yet this represented a 5.3% year-over-year drop. Sales volume is down. Homes sold in January 2025 at 150, down 9.6% year-over-year. Median days on market rose to 43.9 days. That signals weakening demand. Further, historical context weighs heavily. Stockton was the epicenter of the housing bubble collapse, with the U.S. highest foreclosure rate in 2007-2008. And value, declines of 44% in just 1 year in the past. So what are the ongoing risks? First, income and job base are weaker. Major sectors are agriculture, logistics, warehousing, not booming high-wage tech or finance. That means less wage growth, more sensitivity to economic cycles. Second, demographic risk. Migration patterns suggest fewer resilient buyers, with some families moving out or avoiding the region because of crime or public service concerns. Third, oversupply and softness. With homes taking longer to sell, price cuts becoming more common, you face the possibility of negative or flat appreciation for years. That means if you buy now, you could be stuck in a property where the value lags, carrying costs climb, interest rates, insurance, taxes, and exit options shrink. Simply put, Stockton might look like an entry point, but you're buying into a market with many of the most red flag indicators in California. The brutal truth about California's housing market in 2025. Behind the palm trees and postcard sunsets, the numbers don't lie. Home prices are overinflated, incomes can't keep up, and the cost of simply owning, from insurance to property taxes, is rising faster than most buyers can breathe. Over 70% of Californians now say home ownership feels out of reach, and even longtime residents are packing up for states like Texas, Arizona, and Idaho. The so-called California dream is starting to look more like a financial nightmare. If you're serious about buying, don't get caught in the hype. Watch the data, not the marketing. Look for markets with real wage growth, stable insurance coverage, and inventory that isn't bloated with investor flips. Because in this new housing cycle, the winners aren't the ones who buy fast. They're the ones who buy smart. Thanks for watching. And if you found this breakdown helpful, hit subscribe and join us at Discover the Nation for more data-backed housing insights every week. We don't sell dreams. We expose the numbers behind them. Stay sharp, stay informed, and protect your wallet.